So welcome, good afternoon, everyone. Like Jill said, I'm work in the estate planning, succession planning area, and today we're going to talk about succession planning and estate planning. And I know when I think about the two together, I sometimes wonder what the difference is between the two. And I think when you're a closely held business owner, it can be very difficult to tell the difference between succession planning and estate planning, because the two become very commingled, intertwined. Because what you're doing for your business, you need to be considering how it impacts you personally, and so on. So today we're going to talk a little bit about some of the steps and considerations when you're looking at succession planning, more on the business side, and then also share an update on where we're at from an estate planning standpoint, from an estate tax perspective. There's been a few changes in recent years. So that's a quick summary of what we're going to be talking about today. So what are some of the components of a succession or exit plan, another terminology for it? And really it's looking at what are your objectives. You know, what do you want to accomplish if you're looking at transitioning the business, your bank, for example. What is the value of that company or your bank? What is the value that you need for your personal financial goals? If the value of the bank is not exactly what you need it to be from a personal standpoint, are there things that can happen to enhance the value? And then what type of entity or what type of buyer are you going to be looking for? Is it an outside third party, a family member, key employees, that type of thing? So it's looking at all of the different aspects of transitioning a business and how that impacts you personally. So the most important thing is really to identify your personal goals and objectives. How long do you want to be working for the bank? Are you going to just step out of management at some point and continue to own the bank? Or are you looking at transitioning the whole operation, ownership, and everything? What value do you need from the bank in order to meet your retirement cash flow goals? You know, we've had situations in working with closely held businesses where once we put the numbers to what they want for retirement, the value of that business currently maybe isn't meeting those goals. So what can be done from that standpoint? And then looking at who you want that buyer to be. Do you have somebody in the family that's in the business? Do you have other children that aren't in the business? How do you handle that? So there's a lot of considerations from the perspective of who that buyer might be. Some of the other kind of maybe not personal to you considerations, but some of the other things that may be part of your goals or objectives is looking at how will the transition of the business or the bank affect the community. You know, a bank is very instrumental in helping with business development and some of those other community things. So how does a transition affect that? Maybe you've got some long-term employees that you want to make sure are in a good position. You know, how does the transition affect that? And so there's a list of things here that might be a consideration. Some may be more important than others. So it's figuring out how they impact your decision on moving forward. A couple questions that you could ask yourself that kind of dive into this is, what is your vision for the bank if you're not there? And what is the vision for you if you're not part of the bank? Because I think those questions can kind of put in perspective in your own mind which of these considerations are the most important. Another consideration as part of succession exit planning is the value, understanding what that business value is. And again, I mentioned that, you know, occasionally we have situations where somebody thinks the value of their business is here, and we come in and look at it and it's here, and what they need is closer to what they think it is rather than what reality is. And there's things that can be done to maybe make the business look better from a selling standpoint. The other thing is who the buyer is may have a big impact on what you want that value to be. If you're selling to a third party, you're probably wanting a high, highest market rate or value. If you're selling to your child or a key employee, maybe you don't really necessarily want that highest value. You want a value that is going to make sense for the child, for example, or can also save you the most estate tax as part of that process. So sometimes value means different things. Another consideration is sometimes in looking at how you run your business, have you been tax motivated so that you're making your earnings look less than what they maybe really are? Sometimes we have situations where you need to at least be looking at what normalized earnings are rather than what your tax earnings might be, just so that you get into a more realistic value or a more desirable value. So again, the next step is looking at who your purchasers are, who your buyers are. And if you're looking at outside third parties, which I know there's been a lot of consolidation in the banking world lately, so you're looking at outside third parties, what do you need help with, or what can be done to help find that perfect match for your bank? And again, sometimes it depends on, are you looking at needing to get out tomorrow, 6 months from now, or are you planning ahead 5, 10 years? And the longer you're planning ahead, usually the better the outcome is. And then if you're looking at insiders, so to speak, at family members, key employees, what are some of the considerations with that? If it's family members, that's where the estate planning and the succession planning become really intertwined and sometimes hard to separate. You need to be considering the business side. If you're looking at the succession of the business, you need to be considering the business and what's best for the business, probably more than you do what's best for your family. And I know I've been involved in different situations where that is a very difficult process. But if you're, I think for me, I work more on the estate planning side, sometimes dealing with that, the children that are in the business and the children out of the business can be the most, the word that comes to mind is treacherous, but that's probably a little too strong. But that's where a lot of the tension can come in, is dealing with those business and non-business people. If you're looking at benefiting or selling to key employees, do they have the means of paying the purchase price? And how are you going to get them the cash to be able to do that? So that can become a significant consideration too. Is an ESOP a possibility if you're wanting to have the employees, maybe more than your key management group, own the bank? There's a lot of rules and regulations that go around or along with ESOPs, but that might be another consideration. The other thing to consider if you're looking at the transition of a business or the succession of a business, a bank, is what are the important things that need to be considered in order to make sure that the business is going to continue to be successful? You need the management in place. You need to know what that ownership group is going to look like. And so you're looking at the transaction itself, but also looking towards the future and what's going to be important for that business to succeed. And then we get into, again, your personal goals and how you build in estate planning with the succession or the transition of the business. And maybe as part of a transaction, you're wanting to benefit charity. You're going to have a sale, and for whether you're wanting to save income taxes or you just want to make sure you're benefiting your community, there's ways of building charity into that process. Are you wanting to structure things so that you can potentially save some estate tax as part of the transition? Those are definitely things that can be done, but they can't necessarily be done the day before the sale closes. So those are some things that you really need to give some thought and make sure they're part of the process from the beginning. So in a nutshell, succession is never just about succession. You're needing to consider a lot of things from a personal standpoint and then also from the business standpoint. Again, just making sure as part of this to make it a successful succession. That's a tongue twister. Another thing that's very important is considering your own emotions. I know we've had a situation where we had a business all lined up, the buyer was there, the seller was there, and at the end of the day, the seller just couldn't sign on the dotted line. He just wasn't emotionally ready to give up or to transition that business. So it's, again, really making sure that you're ready to make that commitment. Again, making sure that you're considering the business first so that it's more likely to succeed through the transition and allows sufficient time. Again, you can't do this. You can do it overnight, but that's not the best way to do it. With a lot of planning, you're going to make sure that you maximize your benefit from the transition. Why do business owners a lot of times not want to deal with planning for this? Sometimes there's some unpleasant management issues that come up. Maybe there's key employee issues or something that the owner just doesn't want to deal with, and so they keep pushing it off. It does make estate planning too, makes someone consider their mortality. I've dealt with a lot of clients that just don't want to deal with any estate planning because that means, estate planning takes effect when you die, and people don't want to deal with that. People are too busy doing just their normal everyday tasks, and so this is always at the bottom of the list and never gets above that. And then a lot of times people just don't know what to do, and so they never get started. This is a statistic from the Family Business Institute, but it shows that it shows the benefit of planning ahead because the percentage of a successful business definitely increases the more planning or the longer that the planning is taking place. So that, in a nutshell, is some of the steps to go through if you're looking at succession planning. And so that's focusing more on the business side than your personal side, although, as I've said, they're very intermingled. And now we'll talk about estate tax, which is what I live and breathe every day. So where are we at from an estate tax perspective? Well, I can tell you where we're at today, but I can't tell you where we're going to be a year from now. But I'll give you some of the scenarios that are possible. So as part of the tax reform, and Jill mentioned this in the general tax session, as part of tax reform a couple years ago, we do have a significantly higher estate tax exemption. It's currently $11.4 million per person, so a couple can transfer $22 million to family without incurring any federal estate tax. The estate tax rate, if you do go over that exemption amount, is 40%. And that has been the same for, probably getting close to 10 years. It's the exemption amount that has fluctuated. Under current law, the way the law is written today, that exemption amount will increase every year for inflation. So next year it goes up to $11,580,000. But then at the end of 2025, we have a sunset of the current law, and starting in 2026, we go back to what the exemption would have been under the old law. And we're estimating, based on inflation rates today, that the exemption in 2026 could be $6.5 million per person, somewhere in that range. As part of the tax reform, portability did not change, so we still have portability, and we'll talk about that in more detail. And the other thing is, and Jill mentioned this too, was that the annual exclusion is now $15,000 per person. It increases every year for inflation, but it only actually increases to be able to use it at $1,000 increments. And so it takes quite a few years to go up from the prior level. The annual exclusion, so that's the gift that you can make to an unlimited number of people every year without using your lifetime exemption. So it's $30,000, as for a couple, it's $30,000 per person. So what's the likelihood of the exemption in the future? And my best guess is, I don't know. I've given up trying to guess what Congress is going to do. But just know that even before we had tax reform, there was always legislation in Congress, somebody wanting to repeal it, somebody wanting the exemption to go down. So that's always been a risk. The problem with the law the way it is today, at least from my perspective, is that under current law, the exemption is going to go down. The problem from an estate planning perspective is we're not planning for this year. We're not planning for next year. We're hoping to be planning for 20, 30 years down the road because it is your death that's the triggering point for the estate tax. So it makes it very difficult to plan when we don't know what the exemption is going to be going forward. There continues to be bills in Congress I think there's still bills that come in to repeal the estate tax. I don't see that as very likely in the near future. There's definitely bills to reduce the exemption amount, go back to $5 million. There's been a bill to go back to $3.5 million. One of the bills introduced this year as kind of a budget, the way to make the budget work was to, instead of the exemption going down in 2026, it would go down in 2023. Because I don't know if you know how Congress works, but they look at a 10-year span. And that's why 2026 is the magic year, that was the 10-year window. So they were looking at, I think it was actually changing the kiddie tax back to what it was, and the way to pay for that was to have the estate tax exemption drop sooner than 2026. If you've been following the debates, you probably know there's lots of proposals out there from the Democratic candidates on the estate tax. A lot of them are reducing the exemption, some significantly increasing the rate. So in a nutshell, we have no idea what will happen in the future, really. I think there is a fairly good chance, especially if the Democrats sweep a year from now, that the exemption will go down. What will it go down to? I don't know. My guess, and this maybe shouldn't be recorded, but my guess would be maybe $5 million. I really can't see it going lower than that, but who knows? The difficult part of planning right now is that there's really, in the past, and I've been doing this for a long time, in the past, we always wanted to save the estate tax because that was, the exemptions were low and the rate was high. Now with the exemption so high, that step up in basis that Jill referred to has become as important, if not more important, than the estate tax. So it's balancing saving estate tax when appropriate with maximizing the step up in basis. And I'll give you an example. So I had a client in the other day who is adamant he wants to take advantage of the higher exemptions, the $11 million exemption. The thing that you need to consider if you're looking at gifting and using that exemption is that you need to gift the $11 million. You can't gift $5 million and have that be the top $5 million, okay? If you want to use the full 11 million, you have to give away 11 million. Well, this client has $20 million. So, yes, he would be a married couple. He would be saving estate tax if the exemption goes down by giving it all away, but he's given up the step up in basis on a lot of real estate that has no basis. So one of the messages, and we'll get into this in more detail, but one of the messages, I think, is you need to be considering that the exemption is going to go down. And if you're wanting to possibly take advantage of it, be planning for it. But depending on the type of assets you have, I maybe wouldn't pull the trigger today, but a year from now, you may be wanting to pull the trigger depending on where the election looks like it's going. So I think it's starting to plan and consider that potential drop so that we're ready to act. The other thing is that there's a lot of things you can do that you don't want to wait till the last minute. We went through this at the end of 2012, and for us that are doing planning, it was not a fun time because we were dealing with a lot of clients wanting to push things through. It got more expensive, for one thing, because there was a lot of demand for that work, and things didn't necessarily get done the way they would have been done if we'd had more time for planning. So again, I just encourage you to start planning sooner than later. One other thing on the sunset potential in 2026, there was a question when this law passed, and we've had it before too. What happens if I give away the $11 million? The exemption drops to $6 million, and then I die. Does that difference, the $5 million, become subject to estate tax? Because at death, the exemption is down here. And the IRS did give us regulations that say that the difference will not be subject to estate tax. So that was the good news that we didn't have an answer for before. The other thing to mention, because we are in the border, I don't know how many of you might be in Minnesota, but Minnesota still does have an estate tax. North Dakota does not. The Minnesota exemption today is $2.7 million per person. It will increase to $3 million next year, and I am not aware of any legislation in Minnesota to increase that. So if you are in Minnesota or you have real estate in Minnesota, you'll need to consider the Minnesota estate tax. Portability, and there's a heading missing on this slide, but portability is a concept that came into place, again, actually approaching 10 years ago. And this is a concept that if I die and don't use my lifetime exemption, and my husband files an estate tax return, he has not only his exemption, but he has my exemption. So if I give everything to him, I don't use any of mine, he has 22 million of exemption rather than 11. That has been a real game changer in estate planning, in my opinion, in the fact that in the past, if we wanted to use both spouses' exemptions, we had to make sure that the plan was set up and the assets were owned the right way. So at the first death, you used the $5 million, and then at the second death, you used the $5 million. Portability has made that a lot easier to deal with because sometimes the asset mix just doesn't work to have, assets in each spouse's name. So portability has made that easier. The other benefit of portability, which is actually becoming more important, possibly, is the fact that you have an opportunity for a second step up in basis. So I die today, my assets get a step up in basis. Everything goes to my husband. He dies 20 years from now, he gets another step up in basis. So, and with if the exemptions stay high like they are now, you're passing a lot of net worth to the next generation, but still have that additional income tax savings on top of the estate tax savings. No, it does not. I was going to mention that. Nope, that's okay. I think there are a couple states that have now gotten where portability is available, but it's nowhere close to here. So unless I think it's 2 states out on the East Coast. But for here, we need to plan differently for Minnesota to take advantage of the exemption. Another consideration with this is that for generation skipping purposes, the exemption is not portable. So what is generation skipping? Generation skipping is a planning technique that's been around for a long time, but in the past, grandpa died, gave everything to son. You have estate tax at grandpa's level, estate tax at son's level, and then it gets down to the grandchildren, at the net of that. With generation skipping planning, you're transferring assets that are ultimately going to be the grandchild's, can have potential benefit for the child also, but you've skipped that level of estate taxation. And there's a limit on how much you can do with that. It's $11 million per person, but that is not portable. And there's ways around to use portability from a federal estate tax standpoint, but not for GST. So it's just part of the planning that needs to be done. Some of the challenges or advantages of portability, I think we've talked about. Some of the challenges with portability, the primary one is that you do need to file an estate tax return, even if there's nothing on it. If I died owning no assets, my husband would have to file an estate tax return for me in order to have my exemption. And it needs to be filed in a timely manner. And if you don't file within the prescribed time frame, you're out of luck. Especially for estates, if you're over the exemption amount, if you don't file within 9 months plus an extension, there's nothing you can do with the IRS. If we're under the exemption amount, there's some things that we can do, but just know that you need to be doing that on a timely basis. So that's kind of where we are today from a rule standpoint. So now what do you do? One of the things that I think has changed a lot is how the estate plan can be structured. And I don't know about you, but I like pictures, so we'll use this to kind of illustrate my comments. In the past, when we had to use the exemption on both deaths, and especially when the exemption was much lower, we always set up, see if I get my thing to work here, we always kind of set up a 2-trust estate plan. So on the first death, whatever the exemption amount would go into this family trust. So let's say the exemption was back when it was $3 million. $3 million would go into an exemption trust, be taxed at the first death. Spouse could get benefits, no step up in basis on the second death because it's not subject to tax. Everything else was in the surviving spouse. And we did that to take advantage of the lifetime exemption on the first death. Now we don't necessarily need to do that because of portability. So one of the ways of dealing with that is that everything can go to the surviving spouse, but there may be reasons to have assets that are funding that family trust. Maybe you're in Minnesota, so you want the $3 million of Minnesota property to go in here. Maybe it's a second marriage where you're wanting some protection for the surviving spouse. So, if the surviving wife marries the pool boy, is always the joke. She's not going to give it to the pool boy. Whoops. So you put assets into that trust in order to protect it. So this is a more common way of doing things now is making a decision at the time of that first death rather than automatically funding that. And it's done by doing a disclaimer, which is basically a refusal to receive property. Property's going to come to me at my husband's death, but I'm going to say, whoa, I want it to go into that family trust for whatever the reason might be. The other thing is that it could still be going into this trust automatically. Again, a second marriage situation is a good example of that. But we can still make decisions on whether that's going to be included in the surviving spouse's estate and get that second step up, or whether we want it to be using the first spouse's exemption and not get that second step up. So kind of the key thing to keep in mind is that because of the unknown future of the estate tax, trying to keep these plans as flexible as possible so that we can take advantage of whatever the law is at the time. There are things, too, that can be done to maybe take better advantage of the higher exemption. So let's say we've had the first spouse died years ago, and that family trust was set up because at that time we needed to use that spouse's exemption. And farmland might be a good example of property that went into that trust. The way it's written right now is there's no step up in basis on that asset. Well, maybe the surviving spouse is no longer subject to estate tax. So there might be things that you could do with the provisions in that trust so that we do get that second step up in basis. So keep in mind that if you have some of those family trusts that have been around a long time, or have clients in the bank that have those, there might be things that can be done. Another thing is that with ownership of businesses, in the past we were always trying to discount them as much as we could. You may have created a family limited partnership to own assets so that we could discount them for lack of control and lack of marketability. Maybe you don't need those discounts anymore. Those discounts are reducing your basis, the step up in basis at death. So are there things that you want to do with some of those entities to get rid of the discounts or at least reduce the discounts? Maybe things can be done with the partnership agreement. Maybe there's cases where you don't want the partnership anymore. You just want to get rid of it and make sure you're maximizing the step up in basis. Another question that has come up is life insurance. I know initially back after December of 2017, we were getting lots of questions on life. Do I need this life insurance anymore? I bought this life insurance to pay the estate tax. Now I won't have an estate tax, so can I just get rid of it? And maybe that life insurance is sitting in a life insurance trust so that it wasn't going to be subject to estate tax. A couple things to consider with that is, one, don't make this decision based on what the exemption is today. Make that decision based on what the exemption could be in the future, such as in 2026. You may not have estate tax today, but you may have estate tax in 2026, or sooner. So don't get rid of that insurance if you're going to need it later. The other thing is that if it is in a trust, and let's say there's cash value in it, and so the trust is going to get some cash if you cancel that policy, that cash is probably not able to come back to you as the person who created the trust. The trust has beneficiaries, and you're going to technically need to follow the terms of the trust agreement rather than just undoing the whole thing. This is a list of some other things that could be considered as far as what to do with the exemption, the high exemption today. We've had situations where people use their exemption back, say, in 2011, 2012. They used that $5 million that was available then, and maybe you gave bank stock to your banking child, and you didn't do anything for your other children. One of the things you could do today with that higher exemption is equalize those gifts if you're wanting to do that. Maybe they were buying stock on a note, and you've decided that you don't really need the cash from the note, so maybe you can forgive that loan. those are just some of the examples, and there's more on that outline. So for rest of the time, I'm going to give you kind of a highlight on a couple of the techniques that we're currently using to take advantage of the higher exemption or to reduce that potential future estate tax liability. Sometimes these will work even if you don't have an estate tax, but it might be a way of transitioning stock to family members. It might work from an income tax standpoint also, but more from a estate tax perspective. One of the techniques that I think is going to become very popular if we do really think the exemption is going to go down is what we call a spousal lifetime access trust. And this is the part of the discussion where we get into a lot of acronyms. So I apologize in advance if I lose anybody, just wave your hand and I'll try to back up a little bit. But the SLAT is what we call this. And what this technique does is that, like I said, if you're going to use the higher exemption, you have to give away $11 million of property. Well, there's not a lot of households that can give $11 million of property away and still have what they want for their living expenses, or maybe from a control standpoint too, a little bit. So the SLAT is a way of giving away property but keeping access to cash flow. And how this works is one spouse sets up a trust for the benefit of the other spouse. This, for income tax purposes, is considered still your property, but for estate tax purposes, it's out of your estate. So during your spouse's lifetime, you have access to the cash if you need it. It can be a required distribution or it can be a discretionary distribution to the spouse, but you haven't lost access to the income. You've lost access to the property, but you haven't lost access to cash. Then at the end of the term, which is typically the spouse's lifetime, whatever's left in that trust will go to the children or a trust for the children, some type of ownership for the children. One of the key things to keep in mind is because this is out of the estate for estate tax purposes, there's no step up in basis on those assets. So sometimes that's an important consideration if you have low basis assets. But this would be one way of putting $11 million into the trust, taking advantage of that high lifetime exemption, and still having access to cash flow. Now, there are risks associated with this. Covered those. What happens if that spouse dies? So I create a trust for my husband, he dies. The general rule, or how you need to think about it, is that you've lost access to that cash. So sometimes we do two trusts, so that we've split that risk. With the exemption the way it is today, that's probably not going to be as likely as it was before, but that is one option of keeping those assets available. A spouse can have, there's some commentators out there that say that the spouse beneficiary can have a power of appointment so that the person creating the trust can get access to cash later. I would not go into it planning that is a possibility. I think that's something that maybe the IRS may argue at some point in the future, but that is a possibility. You also need to consider divorce, because if divorce happens, then you have a potential of getting the cash not being available. You can create two trusts, like I said, and here's some sample provisions. The other two techniques are very comparable, but there's differences, and these have been around a long time. They're not necessarily to take advantage, they don't necessarily take advantage of the higher lifetime exemption like the spousal access trust does, but these are more leverage techniques, so you're using maybe less exemption, but really moving appreciation out of the estate. And what both of these techniques do is you're transferring assets to a trust. Again, it's a grantor trust for income tax purposes. So for income tax purposes, you're still the owner. For estate tax purposes, you're not. With the GRAT, you're getting an annuity back in exchange for transferring the stock. With the intentionally defective grantor trust, you're doing a sale of some stock and then an installment note or selling stock to the trust for the difference. The benefit of both of these techniques is you're transferring future appreciation out of your estate is the primary one. You still have access to cash because you are getting an annuity or no payment back, but you've got that initial value out of the estate. You can also be taking advantage of discounts that you may not have otherwise. There's a couple slides on the advantages and disadvantages, but the main difference between the two, or a primary consideration between the two techniques, one with the GRAT, you're getting that annuity back, so you can do it without having any taxable gift, but that annuity payment is a fixed amount. That has to be paid every year. And if the trust, so let's say you have your S-Corp bank that you're transferring, that S-Corp bank sitting up here is going to make dividend distributions to the trust, and that cash is used to make the annuity payments. If that cash is not sufficient to make the annuity payments, you have to give stock back. And you have to have a valuation done every year to determine the number of shares that need to go back. So there is not a lot of flexibility in what you can do from a payment standpoint. With the intentionally defective trust, this is a sales agreement, and we have a lot more flexibility, in determining what that note payment is going to be. So if you, and we can try better to match it to the actual cash flow from the bank. So maybe the bank has consistently made distributions of X. We're going to make that annual note payment be approximate to X. Maybe it's interest only, small amount of principal for a while with a balloon payment. We've done cases where we've set a longer term for the note and then prepaid on the note because they've actually had excess cash. So you have a lot more flexibility. And so really in a situation, it depends on the cash flow a little bit on which technique to use. But like I said, this trust is still considered you for income tax purposes, but it's out of your estate for estate tax purposes. And that's really the perk there. The other thing to maybe mention on the sales standpoint, well, either of them, even though you're basically selling the stock, there is no income tax consequences from the sale because you're selling to yourself for income tax purposes. So with that, I went through that really quick. So if you have questions, let me know. But the lessons to keep in mind is one, you got to consider the sunset provisions. We don't know what the law is going to be in the future. And then because of that, building flexibility into your plan so that we can make decisions at the time of your death based on the laws and facts at that time. And I'll be sticking around, so if anyone has any questions, feel free to ask. And the word for CPE purposes is BASE. B-A-S-E. What was the sign-in word, Jill? observe for those that didn't hear that. Thank you very much.